Let me ask you something simple, yet deeply uncomfortable. If you owed nothing to anyone, how differently would you think? How much clearer would your judgment be? Because the truth is, most people don't lose their wealth through bad investments. They lose it through bad decisions forced by debt. Here's the question everyone faces at some point. Should you invest or should you pay off debt? The answer isn't glamorous. It won't make headlines or sell courses, but it's the difference between financial peace and financial prison. Let's start with something brutally obvious that most people somehow ignore. Debt is a negative investment. If you're paying 15% interest on your credit card, that's a guaranteed loss of 15%. Meanwhile, even the smartest investors in the world can't guarantee you a 15% return in the market. So when you carry high interest debt, you're effectively investing in a business that's designed to make you poorer. No rational person would ever buy stock in a company that loses 15% a year, yet millions do exactly that when they delay paying down debt. The smartest financial decision you can ever make is often the simplest. Remove the guaranteed losses before you chase the possible gains, because compounding doesn't care what side of the table you're on. When you owe, it compounds against you. When you own, it compounds for you. The mathematics of compounding doesn't forgive ignorance. It punishes it quietly, daily, and relentlessly. But numbers alone don't tell the whole story. There's an emotional cost to debt that's far greater than interest. When you owe money, every decision you make is clouded by pressure. You start thinking in weeks, not decades. You start reacting instead of reasoning. And that emotional volatility leaks into every part of your financial life. Freedom from that pressure isn't just about numbers. It's about regaining mental clarity. A debt-free person thinks differently. They can afford patience. They can afford wisdom. People often confuse leverage with brilliance. They think using borrowed money to invest is a shortcut to wealth. It's not. It's a shortcut to disaster. Because when markets rise, leverage looks like genius. But when markets fall, leverage reveals character. Real intelligence isn't found in how much you can borrow. It's found in how long you can survive without borrowing. If you need leverage to look smart, you were never smart to begin with. Paying off debt is not an act of financial retreat. It's an act of strength. It's not about losing potential returns. It's about building a foundation solid enough to handle opportunity when it comes. The investor who is debt-free can think long-term. They can let compounding do its quiet work without interruption. The one burdened with debt, on the other hand, is forced into short-term thinking. They need results now, and that impatience is the enemy of compounding. And yes, there's a balance. There's a time when the math says you could invest instead of paying off low-interest debt. But understand something vital. The goal isn't just to maximize profit. It's to maximize peace. A spreadsheet can't measure the value of sleeping well. If paying off debt gives you peace of mind, that peace will make you a better investor in the long run. The calm mind always outperforms the clever one. Once you've escaped the gravity of debt, your perspective changes entirely. Every dollar you invest after that compounds cleanly. No mental interference, no fear, no weight on your shoulders. You finally understand the quiet power of financial freedom. You stop playing defense and start playing offense. The money you once used to escape debt now builds wealth. And that transition feels like magic, but it's not magic. It's discipline compounded. So when you ask yourself, should I invest or pay off debt? Remember this, your first investment should always be in your own peace of mind. Because once you remove the guaranteed losses, once you silence the noise of owing, your ability to see opportunity multiplies. The path to wealth is not about being aggressive. It's about being consistent, rational, and patient. In the end, every dollar you owe limits your freedom. Every dollar you own expands it. You don't build wealth by gambling. You build it by removing fragility from your life. You don't get rich by chasing what's uncertain. You get rich by mastering what's guaranteed. Pay off your debts, stay out of them, and let your discipline do the compounding. The day you owe nothing is the day you start truly investing, not just in assets, but in yourself, and that's the kind of return that never stops growing. Most people think of debt as just a number, something you manage with monthly payments and a little discipline, but that's a comforting illusion. Debt isn't just a financial obligation. It's a silent partner that takes a share of your future before you've even earned it. When you owe money, every dollar you make already belongs to someone else first. You become an employee of your past decisions. Think about what interest really is. It's a reverse compounding machine working against you 24 hours a day when you borrow at 15%. You're not losing 15% once. You're losing it every single year until it's gone. That means your $1,000 debt doesn't stay at $1,000. It grows into $2,000, $3,000 or more while you sleep. That's not a small mistake. That's a guaranteed loss compounding against your financial life. And here's the painful irony. People chase investments that promise uncertain gains of 8% or 10% while ignoring the guaranteed 15% they're losing to credit card companies. It's like trying to fill a leaking bucket while pretending the hole doesn't exist. No matter how much water you pour in, you'll never fill it. The first rule of compounding wealth is to stop compounding losses. The real cost of debt isn't only in the money you lose, it's in the opportunities you never get to take. Every interest payment you make is money that could have been invested, saved, or used to create freedom. It's the invisible tax on your time, your focus, and your potential, and over the years, that cost becomes enormous. Not just in dollars, but in what you could have become if you weren't constantly catching up. Debt takes away your ability to make calm, rational decisions. It forces you to think in terms of survival, not growth. When you owe money, every choice feels urgent. You can't invest patiently because your mind is wired for quick results. You start chasing risky returns, hoping to outrun your obligations. That's how people stay stuck. Not because they don't earn enough, but because they never escape the drag of compounding debt. Understanding the real cost of debt is the first step toward true wealth. Because once you see debt for what it really is, a guaranteed negative return, an emotional anchor, and a thief of opportunity, you stop tolerating it. You start treating every dollar of debt as an emergency, not an inconvenience. The smartest investors don't just compound money, they compound freedom, and that starts with cutting off the guaranteed losses before chasing the possible gains. Every financial decision eventually comes down to a simple trade-off between what's guaranteed and what's probable. Most people ignore that difference because probability feels exciting. It offers the dream of more. But the truth is, a disciplined mind always prefers certainty over speculation, especially when the stakes involve your future stability. When you pay off high-interest debt, you're earning a guaranteed return. If you eliminate a 12% loan, you've just locked in a 12% gain with zero risk. There's no market crash, no emotional panic, no sleepless nights, just quiet, certain progress. You don't need a bull market or a lucky stock pick to make that return real. It's built into the math. You're removing a guaranteed loss and converting it into a guaranteed win. Now, compare that to investing. The stock market has averaged around 8%, 10% annually over long stretches, but that's an average, not a promise. Some years give you 20%. Others take away 30%. In between, your emotions swing with every headline and your confidence fluctuates with every dip. That's not a guaranteed return. That's a test of temperament. Intelligent decision-making recognizes the difference between a mathematical guarantee and a hopeful projection. It's not that investing is bad. It's that the timing of it matters. Paying off debt first builds a foundation of certainty. Once your guaranteed returns are secured by eliminating liabilities, you can afford to take calculated risks. You invest from strength, not desperation. You invest because you can, not because you have to. Most people chase probable returns before securing guaranteed ones. They hope the market will outperform their debt interest rate, but hope isn't a strategy. It's a gamble. The guaranteed return of paying off debt might seem boring, but boredom compounds wealth far better than excitement does, because certainty frees your mind, while probability feeds your anxiety. The wise understand that wealth is built on a sequence. First, remove the guaranteed losses, then pursue the probable gains. When you do that, your risk tolerance increases naturally because your foundation is unshakable. Every dollar you invest afterward grows in an environment free of fear, free of pressure, and free of debt. The surest path to financial independence isn't the pursuit of high returns, it's the elimination of guaranteed losses. When you master that distinction, you stop chasing wealth and start building it deliberately, one certain step at a time. Money doesn't just live in numbers, it lives in your emotions. The way you feel about your finances directly shapes the decisions you make. Emotional leverage is the invisible force that either strengthens your discipline or destroys your judgment. And here's the truth. When your emotions are stable, your financial results often follow. When your emotions are chaotic, your finances rarely survive. Debt is one of the most powerful emotional levers in existence. It doesn't just drain your bank account, it drains your peace of mind. When you owe money, your decisions stop being about logic and start being about pressure. You think shorter, you take riskier bets, you feel a constant background noise of stress that eats away at your ability to think clearly. It's hard to build long-term wealth when your brain is constantly in survival mode. Freedom from debt is not just financial, it's psychological. When you owe nothing, your thoughts slow down. You stop reacting and start reasoning. You don't feel forced to chase fast money because your survival doesn't depend on it. That clarity, that calmness is a form of leverage that no spreadsheet can measure. It's the quiet confidence that allows you to sit still while others panic, to think long-term while others are drowning in short-term fear. A debt-free person makes better investment decisions not because they're smarter, but because they're freer. They're not investing from desperation or fear of missing out. They're investing from strength, from a position of choice, not obligation. That's the ultimate form of financial leverage. Control over your own emotions, because once you can master that, the external markets lose their power to shake you. Emotional leverage compounds just like money does. The more calm decisions you make, the more stability you build. The more stability you build, the more confidence you gain. And over time, that confidence becomes a financial advantage. The ability to hold through volatility, to stay rational when everyone else loses composure. Most people think financial leverage comes from borrowed money, but real leverage comes from emotional mastery. The market rewards those who can stay steady when it moves violently. Debt amplifies fear, freedom amplifies patience, and patience over a long enough time horizon outperforms every shortcut and every emotional impulse. So when you remove debt from your life, you're not just improving your balance sheet, you're upgrading your psychology, you're taking back control of the one thing that truly compounds faster than money, your peace of mind, because in the long run, emotional leverage is the engine behind every intelligent financial decision. One of the most dangerous illusions in finance is mistaking leverage for intelligence. Borrowed money can make almost anyone look brilliant when times are good. It amplifies returns, boosts confidence, and gives a false sense of mastery over the market. But leverage doesn't create skill. It only magnifies outcomes. It turns small wins into big ones and small mistakes into disasters. The problem is, most people only see the upside until it's too late. When markets rise, leverage feels like genius. You see your portfolio double faster than others, your confidence grows, and you start believing that your decisions are the reason for your success. But markets are designed to humble overconfidence. When volatility strikes, leverage reveals what it always hides: fragility. Suddenly, the same force that made you look smart becomes the reason you lose everything. Intelligence in investing isn't about making the most money in good times. It's about surviving through the bad ones. Anyone can look successful in a bull market, but it takes real wisdom to endure a bear market without panic or ruin. Leverage shortens your time horizon. It turns you into a speculator instead of an investor. The more you owe, the less patience you can afford. And patience is the very thing that compounding requires to work its magic. True intelligence lies in durability. The ability to stay in the game long enough to let compounding do its work. Leverage shortens that runway. It makes you fragile. It replaces discipline with adrenaline. and it quietly convinces you that you're smarter than you are, right until reality strikes. The smartest investors understand that staying solvent matters more than being spectacular. They'd rather grow slowly and securely than gamble for speed, because once you lose big, you lose time, and time is the only ingredient compounding needs. The investor who avoids leverage may not get rich quickly, but they stay rich permanently. Leverage is like fire. Useful in control, deadly in excess, it can help build wealth when used wisely, but it destroys those who mistake luck for skill. The real game isn't to look clever when everything is rising. It's to remain unshaken when everything falls. That's the kind of intelligence that never needs rescuing. In the pursuit of wealth, most people measure success only in numbers, returns, percentages, or portfolio size, but that's a narrow definition of winning. True wealth isn't just about how much you earn. It's about how calmly you can live while earning it. There's a hidden cost to chasing profit at all times, and it's often paid in stress, anxiety, and sleepless nights. The goal should never be to maximize returns at the expense of your peace of mind. Peace has a price, and it's often found in the decisions that don't look optimal on paper. Maybe it means paying off a low-interest debt instead of investing for a slightly higher return. Maybe it means holding more cash than experts recommend, or saying no to an opportunity that doesn't feel right. Those choices may not impress a spreadsheet, but they protect something far more valuable: your mental clarity. When your finances align with your temperament, you stop feeling like you're at war with your own money. People often forget that every percentage point of return comes with a corresponding amount of emotional volatility. If a 10% return makes you restless, second-guessing your moves and checking prices every hour, that return is costing you more than it's worth. Peaceful money compounds better than anxious money because calm minds make consistent decisions. You can't compound properly if your emotions reset every time the market trembles. The idea of paying the price for peace doesn't mean avoiding risk entirely. It means understanding your limits, knowing what kind of volatility you can stomach without losing focus. The most successful people aren't those who chase every dollar. They're the ones who build systems they can live with for decades. They value sustainability over excitement. They know that peace creates longevity, and longevity creates wealth. Profit without peace is fragile. It depends on constant momentum and endless optimism. Peaceful profit, on the other hand, is resilient. It gives you room to think clearly, to act deliberately, and to stay in the game long after others burn out. If you have to choose, always choose the path that lets you sleep well, because in the end, the ability to think clearly is more valuable than any return you'll ever find in the market. The best investment you can make isn't always the one with the highest yield. It's the one that lets you live without regret. Escaping debt feels like breaking free from a cage, but what you do after that freedom determines whether you stay free or walk right back in. Most people see becoming debt-free as the finish line, when in reality it's only the starting point. The true challenge begins once the burden is gone, because the habits that built your freedom must now protect it. Financial peace isn't permanent. It has to be maintained through discipline, awareness, and respect for money's power to either serve you or enslave you again. When you're no longer trapped by monthly payments and interest charges, life suddenly feels lighter. You have choices. You can think long-term again. You can breathe. But that freedom creates a subtle temptation to ease up, to spend a little more, to believe you're safe because the danger feels far away. That's how debt returns, not through big, dramatic mistakes, but through small, comfortable ones. The same carelessness that once seemed harmless slowly rebuilds the cage you just escaped. Staying out of debt requires the same mindset that got you out: humility, patience, and restraint. You have to remember what it felt like to owe, and keep that memory alive enough to stay cautious. It's not about fear, it's about respect. Debt punishes arrogance and rewards prudence. When you treat credit as harmless, it eventually takes control. When you treat it with discipline, it remains a tool, not a trap. Once you're free, your focus should shift from escaping debt to building momentum. Every dollar that once went to interest can now be redirected toward ownership, assets that work for you instead of against you. Investing becomes different when it's funded by peace instead of pressure. Your decisions are cleaner, calmer, and longer term. You're no longer trying to catch up. You're compounding forward. That's where true wealth begins. Not when you earn more, but when your money starts compounding without friction or fear. The key is to never forget that the cycle of debt is always waiting for a moment of weakness. One impulsive purchase, one unnecessary loan, one rationalized swipe of the card can start it again. But the disciplined mind sees those temptations clearly and chooses differently. Once you've experienced real financial freedom, the kind that lets you sleep without worry, you'll realize it's worth protecting at all costs. Staying out of debt isn't just about numbers, it's about identity. You become the kind of person who refuses to trade peace for convenience or freedom for fleeting pleasure. And over time, that identity compounds into something far more valuable than wealth, self-respect. Because once you're out, the smartest thing you can do is stay out and let every future decision honor the hard work it took to get there. In the end, the question of whether to invest or pay off debt isn't really about money. It's about mindset. It's about choosing certainty over illusion, clarity over confusion, and peace over pressure. Paying off debt doesn't just improve your balance sheet, it transforms your relationship with risk, with patience, and with yourself. It teaches you the kind of discipline that money alone can never buy. When you clear your debts, you're not just freeing your finances, you're freeing your mind. You stop reacting to life and start directing it. You stop chasing luck and start building structure. That's the quiet power of getting your foundation right before chasing returns. Because the truth is, compounding only works for those who can survive long enough to let it work. And survival begins with eliminating the guaranteed losses that come from debt. Once you're free, stay free. Build from a place of strength, not stress. Invest because you can afford to wait, not because you're desperate to escape. Understand that the greatest wealth is not in owning more, but in needing less. Peace of mind compounds faster than any stock or real estate ever will. The smartest path isn't always the most exciting one. It's the one that keeps you calm, consistent, and compounding. When you build your financial life on discipline instead of desire, on patience instead of pressure, wealth becomes inevitable. So don't chase quick wins. Don't borrow brilliance. Don't confuse risk with progress. Pay off your debts, protect your peace, and let time do the heavy lifting, because the day you owe nothing is the day your money and your mind finally start working for you.